Welcome back to another episode of Profitless on Purpose, the nonprofit accounting podcast. And I'm one of your hosts, AJ Wheeler. With me, as always, is Tony Cajigas.
Hello.
And Mark Palardy.
Hey, everyone.
Got a great show for you this week. We have an article, Accounting Under Regulatory Scrutiny. So we'll talk about what joint costs are, how they're allocated, maybe how regulators look at them, and what's changed since the article was actually published. And then we have an article relating to why are people quitting their jobs exactly? So a deep dive into kind of the great resignation that we're currently in and what the reasons listed in the survey are for people quitting their jobs and how this might be a boon to nonprofit hiring. We'll talk about it. And then our last article for the week is the most important time of year. We're talking about quarter four of the calendar year and year-end giving, how you should be going about it as a nonprofit, what you need to know, when you should start planning for that. We'll talk about all that in this week's episode. And then our question for the week and our discussion topic is a questionable donor donated to a museum for an exhibit about climate change, but spoiler alert, they're a polluter. Should you take the money? How do you kind of wade through this moral ambiguity kind of situation as a nonprofit for funders? We'll discuss all that and more on this week's episode. But Tony, you have our first article. Take it away.
Thank you. Today's article that I have is from the Nonprofit Times titled Accounting Under Regulatory Scrutiny. It was a very interesting article. It's basically state charity regulators have been increasing scrutiny over nonprofit financial statements, 990s, solicitation material. The areas of growing scrutiny include like nonprofit allocation of joint costs and evaluation of non-cash donations, which are also known as gift in kind. The regulatory, they believe that the charities are improperly using the accounting principles to hide their fundraising costs, which they believe is not the correct way to do it. So there's several states that have been brought actual enforcement alleging that the incorrect allocation of joint costs and the organization has in fact made materially false statements in their financial documents that they submit. It goes on to say that the state charity offices recently alleged that organizations are unfairly stating their expense ratios in their charitable solicitation material. So some of the other things that they talked about that there were, they list some mistakes that nonprofits often make. One of them was allocation when the solicitation has a no call to action. The second one was over allocating. And the third was selecting the audience based on the ability to actually contribute. So this article was from 2019, and there's back when the article was written, there was no actual precedence. So I would like to throw this out to the panel to see if you gentlemen are aware of anything in recent years that has changed any of this. So what do you gentlemen think?
Yeah, I think if you don't mind, Tony, I'm going to set up the problem in kind of a different term, just so people out there listening can kind of understand what's going on here. So, for example, if I am a nonprofit, in my functional expenses, I'm generally going to have to determine how much of my revenue is actually going to, how much of my revenue and expenses are going towards programs, how much are going towards fundraising, and how much are going towards administration. So it's in this kind of tricky area where fundraising costs, this article is positing, are being kind of hidden and squirreled away in other areas. And so although this article says that, the auditors aren't doing, I don't know if they're presuming that the auditors aren't doing a good enough job of catching this, or if there's just a different metric. And I think AJ is going to speak more to the auditor side since he's our resident expert auditor. But, there is a kind of, I guess each nonprofit organization makes determinations on these allocations of how much is actually fundraising and how much is not. And so if you have like a letter that you're going out and you're asking for something, it's a call to action. The example they give in the article is if I'm a nonprofit that helps with the cessation of smoking, if I send out a letter telling people about the hazards of smoking, and at the end I ask for a donation, then you can allocate that because you're not only doing service of your nonprofit, but you're also doing a charitable ask. But if you're just sending out a letter and asking for money, you're not actually serving your mission. So these are the kind of allocations and the percentages that some state regulators are looking at because they want to get kind of a truth in lending. Like, how much are you actually really spending on your programs, and how much are you actually fundraising, and you're hiding that away? So I'm going to turn this over to our resident expert auditor, AJ.
Well, I think your example of the smoking cessation brochure, pamphlet, or kind of like educational material that's sent out that's also asking for an ask is a really good example of how, there's the rules that are in place, or the guidance that's in place for you to allocate versus like what happens in the real world. And it also kind of shows the divide between the accounting rules and then real life, I guess. So let's first tackle I guess the methodology behind how you would allocate a cost for Mark's specific example of like a brochure being measured out. So there's a couple ways you can do this. It's either with time and effort spent to create this marketing material that essentially is forwarding your mission of smoking cessation and your nonprofit, purpose. And then there's the other part then, of how much time the marketing piece of that or the fundraising piece of that would take. So you could do it by time. You can even do it by quote unquote square footage of this, brochure that's going out. So literally measuring it and finding out how much of it is related to the education portion of your organization and how much related then of that brochure is related to your fundraising, and allocate it based on that percentage. Again, with anything, especially in a nonprofit, but with anything, allocation related, document. If you're going to use this, it should be consistent with how you allocate then that brochure from year to year to year to year. So that's one example. Move to a different example. What if you're a fundraising organization? Your exempt purpose is to fundraise for, like, say, a park. Well, what's fundraising costs or administrative costs, and what's related to your exempt purpose? That's a much more gray area. And I, in fact, audited a client. I had an audit client that was, in fact, a fundraising organization for a similar purpose, like for a park, Friends of such and such park or whatever. So what we prescribed for them was that you kind of parse out the administrative time it took to create marketing materials and put your message out to do the fundraising as your administrative fundraising function. Then the time spent, actually fundraising, and then the effort and time spent fundraising for this park was considered your program expenses. Because it is, if this was a very small organization, we're talking like 2 people with a contract bookkeeper. And, when you read the rules, it's very ambiguous. Everything was considered a program expense to them in their mind, so it can be difficult to parse out. Easier things are like rent, right? Rent benefits all, if you have people working in an office and you're renting something, rent covers, entirety of your programs and your administrative and your fundraising. So the easiest way to do it is either by square footage of where people sit or by time and effort again. So that's kind of, I guess, addressing the allocation of these joint costs. So with respects to the article, though, the real gray area is they're talking about like really two or three different things. Well, three different things, right? They're talking about your 990, your audit, and then your marketing material annual report. So you're talking about two regulated pieces of nonprofit submissions that have to happen: a 990 or a state, kind of report that needs to be placed into there, an audit which has GAAP and financial standards and materiality fairly stated, and then you have essentially a marketing material or a management kind of display of results of operations. There can be some financial information in there, and there's nothing that says that your annual report or your marketing information needs to match your audit and your 990, and there's no regulation behind that. There still isn't, even after 2 years, 3 years later after this article was posted. So I think that's much more up for debate, right? How you're presenting the numbers in your marketing material or your annual report. What's now less ambiguous is how you report that information on a 990 and an audit. So from an audit perspective, there's much more scrutiny in 2018, 2017, that, and even I think when this article was written, there was not much emphasis placed on how you allocated cost. There was a matter of emphasis put out to accounting firms specifically related to these state issues that were coming up that are related in this article, that it wasn't necessarily like a new pronouncement or a new FASB codification or anything, or a new audit requirement. What it was there needs to be an increased scrutiny on how allocations are made, how you're documenting how those allocations are done, how you're identifying like overhead or these joint costs that they're talking about here, and how you're siloing them in the accounting system, and the methodology should be written down, how you're going to allocate those over your program fundraising and administrative cost. So it goes back to my original statement that I think there is some gray area here, and I think you can make good cases for how you're allocating something, but the real devil is in the details, and you have to document these things and have a plan in place that's in writing, part of your fiscal manual, that states the methodology behind how you're going to be allocating these shared or these joint costs. And then you need to present, you need to have the backup for how you implemented that then. So it's a much more, I'm making it sound very onerous, but if you pick a method, you got to stick with it and then continue to apply that same methodology that you've written down as support for your allocation entries you're making.
I don't know that there's much more to say following up our audit wonk over here. So appreciate the insight, AJ. And basically understand, I guess the bottom line is understand what your state agencies are looking for, understand how GAAP is, and understand what the federal regulations are, right? If you're making these allocations, your auditor, if you're having an audit annually, they should be able to help guide you into what best practices are. But on the management side, you got to just try to play it honest and play it fair and listen to the guidance, because you really don't want to be on the other side of a state agency saying, hey, you're over allocating in this area.
I think also too, Mark, really quick, I think it's good to point out that nonprofits are about as transparent as a corporation or an organization can be. So people have access to your 990. They can't, usually nonprofits make their audit available on public record. So just remember that we live in an information age where a lot of these things can be sussed out, I guess, from a 990 even, or if you make your audit publicly available, or if, gosh forbid, you have to do an UG audit, that gets uploaded and anybody can see it. It's in a federal clearinghouse for anybody to see. So I think, and your annual report, of course, you're probably going to link it and send it out. So I think it's really good to be open and honest and have a very, understand that the public is going to be able to see these things if they want to, and to have a plan in place to not only do it, but to back it up and explain it to somebody, even a donor. Mark, I think you got our next article for us.
Yes, I do. This one is coming from Inc. magazine, and it's not necessarily completely nonprofit, but I think it applies to the nonprofit realm as well. But it is very topical, by Marcel Schwantes, I think. Why are people quitting their jobs exactly? May come down to 4 reasons. So they did a survey of 5,000 employees in both the US and the UK to try to find out why people were quitting their jobs. And teaser, there's some good news for nonprofits in here. Top 4 reasons that leaders attract and retain talent, and or on the flip side can lose them, is providing career growth opportunities is number 1. So 83% of employees think that companies should help with career advancement, but only 44% of people say that their workplaces have no sort of metric methodology for career advancement, which is a surprising number to me. But if you have no room for growth, you're not going to stick around for forever. Second point: don't confuse contentment with loyalty. Right? Everybody thinks, well, our people are content, so we're good to go. But in fact, 53% are considering leaving their job within the next year. So contentment doesn't breed loyalty. So factor that in. Achieving a work-life balance. We've heard this since I've been working for decades, right? Do you have that work-life balance? And a lot of people were saying that work-life balance was better during the pandemic, but now 42% of people surveyed want flexible work schedules or workplaces when they head back to their jobs. As they go back, they don't want to necessarily be working in the office all the time because they've seen that they can do their work outside of the office. So, that is a real push-pull. And then 4, make mental health a priority, right? This is something that's relatively recent because at least in the US, mental health used to be something that was just kind of, swept under the rug. We don't talk about mental health, but this is definitely something that 24% a third of the participants in the survey said they wanted this, and 24% of HR departments don't even prioritize it. So with those 4 things in mind, the next generation that is coming into the workplace, Gen Z, the way you're going to attract and keep their talent is to give them something that makes them invested, i.e. something mission-driven and focusing on company culture and employee engagement. So the takeaway for me is that with nonprofits, there's a real opportunity here to get and retain people by making your, as we always say, making your work mission-driven and bringing your employees in because of the love of the organization and making them part of what's going on and not just another cog in the wheel. I thought this was an interesting article, and I'm curious what you guys think.
Yeah, I was kind of struck. So I imagine I thought wages were going to be kind of top of the list here, but they kind of, it was in there. But I think the career growth opportunities was one that I thought was interesting, right? And I think it goes back to, like what kind of business you're running and if there's growth opportunities there. So I think there was a recent article or a news story about Amazon's kind of philosophy that workers after 4 or 5 years lose their motivation and they want them out and they actively try to get them out. There's no internal kind of promotion. But I think we saw a shift, right? Where maybe in like the 50s, 60s, 70s, you saw a career and, you worked 30 years at some place, you got a golden watch, you made it up the ladder, you started in the stock room and moved to the boardroom kind of idea of upward mobility in a company, and that your tenure somewhere really meant that you were a valuable piece of that company. And I think you saw the shift in like the 80s, 90s, early aughts to where, workers were kind of a disposable commodity where, they would usually look for hiring from without, from outside of the company. And I think you still see some of that residual kind of thing happening today. You don't see that so much in nonprofits. Now, it could be for different reasons, right? Like institutional knowledge and, not having the resources to properly document everything. And you don't want to lose this person with, massive institutional knowledge. But I think a lot of the other things that are listed in the article really do skew towards a nonprofit strength, right? Loyalty being one of them, like having a career growth opportunity. Many of the nonprofits I work with and executive directors I know, it's not like it's not like a management position or something like that, or a CEO status or a founder status where you just start a business. You need that institutional knowledge and experience within that. And a lot of the EDs I know came from being, like the old analogy, right? In the mail and stock room to the boardroom, they started as program managers, they started as fundraising professionals, and they made their way through the ranks to become an executive director eventually, either by happenstance or because that's what the organization wanted. So, and the other thing on the list, make mental health a priority. Well, most or a lot of nonprofits are in the mental health space. And if they're not, I think they, like a lot of like quote unquote sick time includes like personal mental health days in the nonprofit sector. They make a very, they have meditation rooms in a lot of the nonprofits I've worked with. So, like mental health has been, I think nonprofits have been at a good mental health space for a long time. So I think, I guess this article reads to me like maybe for-profit can take a page from the nonprofit book, and vice versa for the nonprofits, paying a livable wage and like making sure that your employees and your partners are paid correctly to have a living wage needs to be done on both sides of the fence, nonprofit and for-profit. So I think it's good news for nonprofits. I think you're going to see people, especially the Gen Z generation, being more, like mission and company value driven, and what they call culture here, company culture. And nonprofits are right up that alley. So I would say this is strike while the iron's hot. You have a lot of people that are leaving their traditional jobs because they're not satisfied. You can really scoop up some good candidates now, I think.
And watch for that Hallmark holiday special, from the stockroom to the boardroom.
Right.
So, you see on the news that there's all these jobs available out there. Businesses are closing. They can't find employees to work. So I like this article because it kind of put things into perspective. I was brought up always thinking, if you don't really like love your job, maybe it's time to move on to find another one. And, I what Mark had said about the 83% of employees think companies should assist with career progression. I think there's a lot of, I guess it also depends on the size of the company. A lot of these bigger companies, they don't communicate very well with their employees. A lot of employees feel like they're just a number. There's no room for advancement. So maybe they're not going to be as loyal, as they should. And I think with this pandemic, I think what it has done with a lot of people is made them rethink their career paths. And the article also mentions work-life balance. And a lot of people are realizing that, hey, working from home isn't that bad. Maybe I can get more done at home. I don't have to worry about the commute. I don't have to worry about work drama, et cetera, et cetera. I think a lot of people are looking for that, maybe really not perfect job, but a job that they are going to like. There's some countries, I believe, that don't even do 40-hour work weeks. And a lot of people, sometimes they feel overworked and underpaid. So, but as far as the nonprofits, like Mark said, I think this is a good thing for them, because people are going to start looking at interests, things that they're passionate about and perhaps make that jump. So, yeah, that's what I think.
Mark, I wanted to ask Mark really quick about what he thought about to attract the candidate of today. Companies need to monetize the channels they use, like SMS, WeChat, WhatsApp, to facilitate communication, and Instagram and TikTok. I want to know, should we be on TikTok?
That gives me gas. I mean, it's hard. It's hard. Honestly, I think that's a whole nother topic of discussion, but I think it's really tricky when you start bringing in a whole bunch of programs that are not able to be monitored or able to be owned by the company, right? So our company, for example, uses Slack, but the Slack channel is paid for and owned by the organization or TCA. And so if there is access to it, and I think probably the admin can see all the channels if they wanted to. But if you're using something like WeChat that's known to be exceptionally private, I mean, countries use it to hide in dictatorship regimes. It's tricky because what happens outside of the purview of the company, but yet the company might still be liable for, right? So, if you have employees who are using WeChat, but it's not sanctioned by the company, that's a different story. If you're officially making it a platform for a way you communicate, but yet you have no control over it, you're opening yourself up to potential lawsuits, because if something goes wrong, or if your employees are behaving in a way on public forums or however in WeChat, it gets dangerous. So I think, we're going to learn new ways of communicating, and there's going to be more social discourse and social commentary, but I think it walks a fine line between liability and privacy. AJ, I think you've got our third article of the day.
Right. This comes from Philanthropy Today, and it's titled "The Most Important Time of Year." So the article is talking about, of course, Q4 and year-end giving, and how, a lot of nonprofits really rely on the December giving push, end of the year campaigns, which is kind of funny because a lot of nonprofits are 6/30 year end. So December actually lands smack dab in the middle of them, but everybody calls them end of the year campaigns because it's the end of the calendar year. So the article essentially sets out the Christmas in July kind of theory that you need to start planning for these things if you're doing a year-end giving or a year-end ask, calendar year-end ask, that this happened, you're planning for this stuff happens earlier rather than later. And the reason being is just the inundation that, if anybody's ever donated once to, or to a charity or something, you get on their mailing list that you've given them money, and you receive, until your probably dying breath, an email or a letter from them requesting funds. You can almost like mark it at the mid-November to late December, you're going to get a letter asking for year-end funds. So essentially the article, essentially says that the whole year should be related to this, and that planning around it, more important than planning for December is planning your comprehensive fundraising efforts for the entire year. You just don't want to wait go into December without a plan for December. So too, you don't want to go into 2020 without a plan for, or 2022 without a plan for 2022. So essentially what the article is proposing is that not only if you're doing a year-end, fundraising campaign, you want to be planning for this 6-8 months in advance. On top of that, what they're saying now is, and we're recording this in the late October, is that you should be planning in the last quarter of the year to be planning for next year's fundraising activities and next year's activities that are, fundraising pushes and essentially funding for the organization. And so I thought this article was very timely and kind of poignant, and it hits home a lot of the advice that I try to give to our clients, is that, forethought and foresight and planning makes a huge amount of difference. When you're trying to throw these things together last minute, it puts a lot of stress on your staff, on your resources. And if you go to the well consistently late to the party, you're not going to get as good of results. So I don't know, I kind of open it to you guys. Is there anything, like advice we can give to the listeners regarding how to plan around these things? Or do you maybe disagree with the article and think that this year-end push should be pushed to a different time of year? If it's actually like maybe getting old hat that you get 20 different mailers in December. So anyway, I'll open it up to you guys.
Yeah, I actually want to respond to that latter question because I was going to mention this anyway. This is the difference between a business operation, meaning the nonprofit, and people, right? Because people individually have a 12/31 year end. They are trying to put those charitable donations in the final push of the year, but while they're still in their individual tax year. And not to mention, we have Judeo-Christian society in the US that values giving around Christmas time, around Hanukkah. And I apologize, but I'm sure there are Muslim traditions as well that give in near the end of the year. So even I think that the idea that the fiscal year end is on 6/30 is a feature, not a bug, right? So that you capture all these individuals' donations in December, but then you might still be counting them up and getting some stragglers in January. Doesn't matter for your books because it's all going to be captured in the same year as an organization. I think definitely, AJ, I agree that there might be other points of the year that it makes sense to have a fundraiser or to do other kinds of fundraising. But just historically, and speaking from the average citizen, they're thinking about donations and giving at that time of year, right? It's when the food banks are open, and it's winter and people are in need, and there's toy drives and all sorts of other things. So people really naturally, I think, equate December with charity and with giving, more so than any other time of year. So while it would be great for organizations to say, hey, I know you want to give in December, but give to us in February instead, I don't know that you can change the entire mindset from how I'm looking at it. But Tony, I'm curious to hear what you have to think.
I think it just depends on really the size of the nonprofit. I mean, and depending on how many asks you have, how many fundraisers you have throughout the year. I know the end of the year is a very busy time for almost any nonprofit, but I'm sure these smaller nonprofits put a lot of stress on their staff only to the fact that they do have a small staff, and you need you need to get those mailers out. You need to do everything to prepare for what your ask is going to be. Now, the larger nonprofits, boy, they obviously have bigger staffs, more resources, but I'm sure that they probably are really busy all year long. And it's just, you need good leadership, you need good organizational skills to coordinate everything with your staff, get things out on time, make a good plan, step-by-step plan for your staff to have things done at certain times of the year so everything falls into place when they should.
Yeah, great points, Tony. I think also too, it's something to highlight that and was something that we've talked about on the podcast before, is to make sure that your funding streams are diversified. So, the same amount, well, maybe not the same amount of effort, depending on your nonprofit, but the same amount of effort should be, if you have donation base, you should also be looking at grants, contracts, partnerships, in-kind donations that we talked about earlier. I think really having a diversified, first of all, funding list, so not just one huge governmental entity that's funding your entire operation. It puts yourself you can put yourself in risk of, hey, elected officials change, missions of cities, counties, governments come and go. So relying on one single source, in this case, we're talking about donors, can be very, I guess you need to diversify, your funding streams here. So don't put all your eggs in one basket, and definitely don't wait and have the financial health of your organization rely on year-end giving. I would say, if it's one thing I preach over and over again. It's making sure that you have a consistent, steady stream of revenue coming in throughout the year from diversified sources. And whether that means you hold your annual gala in June and have your fundraising push at the end of the year, or you have a consistent flow of grants and contracts coming in for the services you offer, try to diversify that revenue stream. Mark, do you have our discussion topic ready for the week?
I do. This week we have a question that comes in. I thought this was kind of a fascinating conundrum, right? So the question that comes in is the author of this question works at a museum, and they often put on climate-based exhibits or other kind of exhibits similar. And the donors that they seem to attract, some of the major donors are, polluting industries. And in a way, they're organizations that are probably trying to spin or put a good face on their polluting industries by sponsoring these kinds of exhibits. But this person who works at the museum really feels torn and feels like this is not fulfilling the mission of the museum, and that it's hypocritical to have an exhibit on one side and then be raking in money from the people you're exhibiting against. So I think it's an interesting conundrum, and one I think different charities have to face from time to time. Where is your money coming from? Do your donors, are they in alignment with what your mission is? And do they need to be?
Boy, this is a really interesting question. So I think realizing so the mission of the museum, right, is to display this climate change presentation. They're not actually they're not an environmental agency or organization that's actively fighting climate change. So it's a little different than if you were an environmental remediation or law firm, I guess, battling climate change by suing these people, and somehow you put on an educational organization and you're taking money from big oil or something like that. So it's a little more gray in this area, but I think it harkens back to what the public persona would be if anybody found out you're actually taking this money. And I think it's, again, to keep in mind, we mentioned it on this podcast before, this very episode, that, nonprofits are the most transparent type of corporation there is. So, we often talk about the annual report, the audit, the 990. In the 990, you need to reveal where your funding sources came from, and you have to list them by name in your financial disclosure portion of the 990. So if this is big enough money, somebody with the wherewithal to be able to look through that and do a little digging could probably easily find out that this climate, that one of your donations came from some kind of oil, gas, energy company that's causing, problems. I worked with a mental health organization that had the same conundrum come in because they were made available or were notified that they had money that came from recreational marijuana to fund addiction treatment that they were offering. And there was a large discussion regarding that kind of conundrum that they have. Do you want to take money from essentially the state agency that collects tax revenue from marijuana and alcohol, giving to a treatment rehab center? They went ahead and took the money because they thought they could do more good with it than the harm that was coming from the sale of liquor and marijuana, and them refusing the money.
And you can't get addicted to pot, man.
Right. But I guess it brought up the discussion of what if a pharmaceutical company offered them money? Now you're really talking about the belly of the beast, especially from an opioid perspective. So I think it's one of those things. If you're faced with this kind of conundrum in a nonprofit, I think you need to involve stakeholders. I think you need to involve, first of all, you're probably in the development department, or you're writing a grant for this thing. Understand where that grant money is coming from. Give it some thought. And I think even bring it to like an executive meeting or a board meeting to determine whether or not, like this could negatively impact the goodwill of your organization. I mean, I think because at the end of the day, your public persona and your goodwill is what you have as a nonprofit, besides the good work you do in the community. So you're only going to get as much money in the front door from donations. Even grants and contracts that we've talked about before are all relationship driven, and your public persona on how where you're getting your money from and how you're administering your programs is really important. And so I would just use this as a cautionary tale to everybody out there that you really need to take a look at where the money's coming from and realize that, as a nonprofit, you're a few clicks away from people being able to really uncover where the source of funding is coming from.
Yeah, Tony, I'm curious, maybe in your answer, if you could also answer, what would you say to this employee, right? Because we're talking largely to outside people, but what about the people on the inside who have trouble with this kind of?
Yeah, I think there's just such, like AJ said, such a gray area, fine line. As far as the employee is concerned, he has to think of his conscience and how he feels about it, and just make a decision, honestly. But as far as the organization is concerned, I mean, you have to think of the pros and cons, what the repercussions are going to be as far as accepting the money. In today's world with social media, everything's out there. And like AJ said, nonprofits are very transparent. So, people can find out where the money's come from. You don't want to be, I guess you don't want to take that hit on your reputation as being hypocritical. There's a lot of ways, a lot of tentacles on this story. But yeah, I mean, if I were the employee, I would just probably honestly follow my conscience and make a decision based on that. And I guess also depending on how loyal you are to the organization and their mission. And that's it. So there's a lot of pros and cons that you have to think about.
I think from an employee perspective, I think if I was in this person's situation, I would want at least my opinion heard. You know what I mean? And so I think this person that's writing this question probably needs to voice their concerns. And from the nonprofit perspective, I think they need to take the step that those concerns are heard and taken into account in a decision. And when a decision is made, they need to address, either why they took the money or why they didn't take the money, and the justification behind that, or how the concern was addressed. I think is a really, you got to have buy-in from all sides on this one.
Yeah, I think especially with something this controversial, buy-in is key. And if you have your employees who are disgruntled behind the scenes, some of them don't have the option to just move to another job, right? So they might start creating waves. They might start leaking the information, as Tony pointed out, on social media or other places, right? So keeping people engaged, even if you're not reaching the decision that they want to reach, people just want to be heard, as AJ said. And I think that's kind of key. And, on that note, we just want to be heard, and we can't be heard if you're not listening to us. So we really appreciate you listening to us here. That was a terrible transition. I know. Sorry. You can write about it in the comments. We encourage your participation. Feel free to comment on the YouTube. Send us a tweet at ProfitlessPod, and join in the conversation. For AJ, for Tony, for myself, thanks for joining us for another episode of Profitless on Purpose. See you next time.
Thanks, everybody.
Thanks for joining us.